everyone. I'm Andrew Constantinides, an advisor at Jesani Wealth Management. And although we have a multi-asset allocation approach in the plans that we build for our clients, in almost all scenarios, equities are going to play a role in that overall plan. And they really should for the vast majority of investors, because equities have outperformed every other asset class throughout the history of the market, and you'll also get immediate liquidity. Of course, the trade-off in investing in equities is the volatility. You may buy a stock of a company that is doing fantastic, but the overall downturn in the market, or the fact that the Fed raised interest rates in their last meeting, is pulling down the overall market. And unfortunately, that company that you own, or that stock that you own that's doing quite well, will go down in a scenario like that. Now, typically over time, equities tend to recover, but the portion of an overall portfolio that should be allocated to equities really depends on a lot of client-specific factors, things like your net worth, your income, maybe how long you expect to work, what your legacy plan is for future generations, and maybe even just your appetite or your overall willingness to take on risk and your stomach for volatility. Now, it can be a little kind of overwhelming for some investors because there's just so many choices out there in the equity markets. So in this series, first, I'm going to kind of talk about the landscape, what you have to choose from. And then in the second and third video, I'll talk about how our team analyzes particular sectors or individual stocks based on either fundamental analysis or technical analysis. So when we talk about the landscape of equities, just on the New York Stock Exchange, you have over 7,700 individual listed companies. The NASDAQ has about 4,400. And in addition to that, ETFs have gotten much more commonplace in the public markets, and I'll also discuss how they can play a role in a portfolio. But there's over 3,000 different ETFs available for an investor to go online or an advisor to purchase for their clients. So there's quite a bit out there, and the first and probably simplest way to break down the equity markets is by their sector. So here I have a sector breakdown. This is just the S&P 500 that we're looking at here. The first one is basic materials. It's all the way down here in the bottom right. This is companies like Cleveland-Cliffs, U.S. Steel, etc. Then you have real estate. Now, I do want to discuss real estate in a little bit more detail because mostly what these are is publicly traded REITs. The home builders could be included in here, but a publicly traded REIT is you buy the stock, and what you're investing in is a portfolio of properties that's managed by that REIT manager or that fund manager. They could be focused on a particular geographic area of the country or the world, or they could be focused on a certain sector within real estate. For example, you could identify a particular REIT. Maybe you like it because it has 60% exposure to industrial warehouses or e-commerce warehouses, 15% in data centers, and 20% in residential or multifamily properties, and almost nothing in commercial or office space. Because we all know, although commercial or office space was a great sector 5 years ago, that's really not the case anymore. One of the risks in buying a publicly traded REIT, as opposed to a publicly traded REIT that we're also proponents of, and we've identified a few of them that we like right now, is the volatility. And what I mean by that is, well, an example would be in 2020, kind of at the height of COVID-19, when the S&P dropped over 30%. Now, during that time, a lot of these publicly traded REITs, just because they were publicly traded, moved with the ebb and flows of the market, and they were down 30, 40, even in some scenarios, 50%. But the reality is, your house didn't go down 30 or 40 or 50% during that time. And in fact, on average, the privately traded REITs went down about 7 or 8%, then quickly recovered that very next quarter. But just because they are publicly traded, they will tend to move with the overall markets despite the actual valuation of the real estate within that portfolio. Then you have consumer staples. These are things that are somewhat resistant to economic downturn. Think companies like Walmart or Coke or Costco or Nestle, typically selling products that even in a downturn in a recession or a tick up in unemployment, consumers are still going to go out and spend money at these particular companies and support their overall market cap and profits. On the other hand, consumer cyclical, which is another major sector, is more discretionary, consumer discretionary. These are products and services that we spend money on, but in a difficult or challenging economic time, we may cut back our spending in these particular companies. So you see a couple big names here, Amazon and Tesla, two great examples. You can see how these take up a pretty large percentage of the overall S&P 500. Also companies like AutoZone, eBay, Tesla would be part of that sector. And then you have utilities down here. Utilities traditionally are a more defensive play. So if you're looking for some defense against a downturn in the market or the economy, utilities can be a great alternative to some others out there. They'll typically pay a higher dividend than any other sector, and they're usually profitable companies that are profitable. And even if there's a downturn in the economy, people or individuals still need to keep the lights on and pay their utility bills. So it can be seen as a defensive posture, whereas some of these other sectors are more of growth postures. Then you have energy, companies like Halliburton, ExxonMobil, Phillips 66, ConocoPhillips would be in there, so that the major oil and gas companies. Industrials are a lot of the core American companies like 3M, General Dynamic, FedEx. Caterpillar would fall under industrials, and the airlines like American Airlines or Delta. And then consumer services. So this is more of, instead of the discretionary service companies like Google or AT&T, Netflix, T-Mobile, Comcast, Disney would fall under that category. And then you have the financials, which of course are the major banks like JP Morgan and Morgan Stanley, but also the insurance companies are included in here, like AIG. And then you have Berkshire Hathaway, MasterCard, American Express, PayPal's in this category, and also Visa. And then, of course, as we all know, because it's done extremely well over the past 5 or 6 years, is the technology sector. Microsoft, Apple, NVIDIA, Salesforce, Cisco, Intuit, Gartner, or ticker symbol IT fall under the technology sector. So when you've identified macro trends in consumer spending or the markets, that then allows you to zero in on individual companies within this index, or focus on a particular weighted ETF that you can buy within this index, maintain liquidity on, and cycle in and out of stocks that you've identified as likely to outperform the overall index in that way. Now, aside from by allocating stocks based on sector, stocks can also be categorized based on the value of the company, or which is called the market cap. So what the market cap is on a stock or a company is the total value of all the outstanding shares of a company in a dollar amount. Now you can see this this heat map that I have up here is sized out by market cap of that particular company. So you can see that some of the largest out there, Microsoft, Amazon, Google, Meta, Johnson & Johnson, United Healthcare, Visa, these carry a lot more weight in this overall index because of their market cap. Within market cap, you have 3 main categories, maybe 4 if you include micro cap, but you have large cap, which typically is companies with a $10 billion value or more. Usually these are mature and well-known companies within established industries. Large cap tends to be less volatile or carry less risk than a small cap for exactly those reasons that I mentioned. Established industries, profitable, mature companies, and these particular stocks generally have a lot of trading volume, which also helps to control some of the volatility. Then you have mid cap, which is total valuation of between 3 billion and 10 billion. These are usually also established companies, but in industries that have growth potential, but aren't fully mature yet. And then you have small cap, which is companies with a value of under $3 billion. These are usually young companies, maybe in niche markets or possibly emerging industries where you have a lot of growth potential. You're buying into the company early. You're taking some of the risk that that particular company may not be successful or may miss earnings, but you're also participating in the upside if that particular company is successful. And then also you have microcap, which is a lot of the biotech companies. These are very small companies, $100, $200 million market caps, highly speculative, the highest equities out there that you can purchase. Speculation. As long as if you're going to buy a microcap company, it should be a very small part of your portfolio, and you really have to be okay with losing a great deal of money and know what you're getting yourself into. So generally speaking, you have large caps as lower risk and return potential, and small caps is the higher risk, higher reward companies. Now, you can use certain combinations of large cap, mid cap, specialty sectors based on a client's overall goals or risk tolerance, which is exactly what we do. For example, we may design a portfolio for a client who says, I'm really interested in growth. I'm willing to take some risk on the equity side. Then we'll implement some other asset classes in other parts of the portfolio to kind of counter that risk or hedge it. But we may build for that client a portfolio that's heavily weighted in small cap technology stocks and small cap consumer discretionary, and a much lower weighting on utilities and basic materials. Or if we're in a scenario kind of like we're in now, where we believe there's money to be made in the value sector of the market, which is also some emerging companies, but mostly established companies, we may use ETFs and individual stock strategies to have that portfolio for that client more heavily weighted in value stocks versus growth stocks, and more heavily allocated in whatever particular sector we like at that time, like industrials, for example. There's also two other categories that you do hear a lot, much more basic than all the various sectors and market caps, but that's just growth and value, growth stocks and value stocks. So what exactly does that mean? Well, growth stocks is typically, they can be technology, but more importantly, they're usually stocks with a higher P/E, which is the price to earnings multiple, which is really the valuation that the company trades at. What's the value of that particular stock based on its fundamentals, and how much higher is it valued in the public markets because of the growth potential in the future that company may have. So you have a higher P/E ratio. Usually they have a high earnings and growth track record, tends to be more volatile than value companies or the overall market, and are considered riskier than value stocks. And usually a growth stock is not going to pay a dividend. You're buying it specifically for the purpose of investing in that stock, holding it for your hopefully predetermined time period, whether that's 1, 3, 5 years, and then selling that stock and getting a capital gain from the sale of that position. So you're investing in it for growth. Where value, on the other hand, their prices or their stock prices can often appear low relative to the company's assets and revenues and their dividends and their cash flows. And they typically have a P/E or price to book that's lower than the overall market or the particular index that we're comparing it to. And also, they tend to be priced lower than some of the peers that are within their business segment or sector. Um, growth earnings and revenues are usually slower than the overall market. A lot of times they are established companies, but that still have some potential for growth. So overall, I mean, the difference between growth and value is value. A lot of times you're getting a dividend. You can expect lower volatility. It may act as a stabilizer or a more core position in a portfolio, where growth is the higher risk and you're seeking a higher percentage return, oftentimes hoping to outperform the overall index. Now, the last item I want to discuss is ETFs. So an ETF is simply a basket of stocks based on a predetermined criteria. So there's ETFs in almost every sector or market cap you can imagine. You can buy an ETF that focuses on clean energy. You can purchase an ETF focused on cybersecurity companies, international, or cybersecurity companies in the United States. You can buy an ETF on the S&P 500 that's equally weighted. So what that means is right now, if you bought an ETF on the S&P 500, which is what's on the screen right now, you're going to own a lot more Microsoft and a lot more Apple than you own of ConocoPhillips down here, just because it's so heavily weighted. So you could purchase an equally weighted S&P 500 ETF that gives you the same amount of each individual company within the S&P 500. Typically, ETF do have an expense ratio, but very, very low. And what we do is we use a variety of ETFs in some of our equity models, either based on sectors or market cap or the overall market, or specialty areas of the market that we've identified as high growth in the foreseeable future. And we don't typically use mutual funds. And the reason for that is mutual funds, it's different than an ETF because a mutual fund has a fund manager. So when you buy a mutual fund, you're paying that fund manager to manage the assets within that mutual fund. So you're paying a fee, could be anywhere from 0.5% to 1.5%. And by the way, over 95% of mutual funds out there don't outperform their benchmark. They don't outperform the benchmark that they're competing against. Whereas an ETF, an asset manager like us, we identify the specific ETFs or potential equities or stocks that we like. We basically build our own mutual fund within a client portfolio or model, and then implement that, which avoids an additional fee of which can be anywhere from 0.5% to 1%. So this is just the basic equity landscape and what's available out there. In the next video, I'm going to kind of go into some detail on how we identify particular sectors of the market or individual equities as sound investments for our clients and within our models. So thank you so much for watching. If you do have any questions about the equity markets, always feel free to reach out to me. My name is Andrew Constantinidis at Jesani Wealth Management, and you can always reach me at 954-800-8552. Okay, thank you.